Hello, my friends. Today is July 27th, and this is Markets Weekly. So this past week, what a roller coaster in markets. We got some sizable down days and some up days as well. A lot of volatility. What really caught my eye was the tremendous appreciation in the Japanese yen. If you look back, you'll see that over the past couple weeks, it appreciated from about 161 to as low as 152 on the USD JPY cross. So my best guess is that there was some serious deleveraging happening, and that's what I'll write about in my note this week. Now, is this the end or is this a correction? I have no idea. Personally, I bought the dip, and so we'll see how that turns out in the coming weeks. But today I want to talk about three things. First, let's talk about the really good soft landing data we got in the US the past week. And secondly, let's talk about an acceleration in the global rate cutting cycle where Bank of Canada cut for the second time the past week. And lastly, Stephen Moran and Nouriel Roubini came out with some interesting work that details how the Treasury has been goosing the markets and to what extent. So let's talk a little bit about their findings. Okay, starting out with soft landing. So this past week, we got two really important data prints. One, of course, GDP for the second quarter, and the other, the PCE inflation, which is the Fed's favorite measure of inflation. Now, GDP came out and it was great, 2.8% annual rate. Now, recall, on the first quarter, we got kind of a softish GDP print, and many people were thinking that, we're falling into recession and so forth. But this 2.8% totally blows that out of the water. I think economists tend to think that the underlying potential growth rate of the US is about 2%. It's really hard to say now since we've had so much migration, and when you add more people, the potential growth rate for the economy increases in the short term. But in any case, 2.8% definitely suggests that US economy continues to do well. There is no immediate sign of recession. Now, one of the things that the professional forecasters look at when they look at these GDP data is the private final sales to domestic consumers, because they think that is a more accurate measure of underlying demand, kind of like looking at core CPI instead of CPI. Now, the last time around, when we had a weak headline GDP print, they were suggesting that the underlying private final sales to domestic consumers was pretty good, so that headline print was misleading, and they were right. Now, this time around, when you look at the same number, it's still suggesting very strong underlying private final demand at 2.6%. Now, that suggests that going forward, the GDP is probably going to be fine. Looking at the Atlanta Fed now GDP casting, again, we only have a few weeks of data. It's also suggesting that so far, based on everything that we see, GDP continues to be above trend. So things are going well when it comes to growth on the soft landing part. Now, what about the other part, inflation? And that's been the Fed's focus for the past few years, much less so today as inflation has come down. Well, PCE, the Fed's favorite inflation measure, printed at 2.6% year over year. Again, that is above the 2% target, but if you look at the trend over the past few months or past few quarters, inflation is definitely moderating towards the Fed's target. Now, on a month-over-month basis, core PCE printed at 0.2%. Now, look at this data series over the past few months. You'll notice that, so we had, of course, the inflation surprise first quarter, where on a month-over-month basis, core PCE spiked and kind of freaked everyone out. But since then, it's been definitely moderating, suggesting that that spike up in the first quarter could have been a blip. So looking at this core PCE measure, I think that the Fed is going to take a lot of comfort in it. And indeed, the market right now is pricing in about 3 cuts this year. And as we have a Fed meeting this week, I think the expectation is widely that the Fed is going to try to guide the market towards a September cut. So when you're thinking about soft landing, again, growth is strong, inflation coming down, things are looking pretty good so far. But that's not the case in all other countries. And so that takes us to our next topic, what's happening in Canada. So As you recall, this month, the Swiss National Bank kicked off the global rate cutting cycle by cutting rates. They have since cut again. The ECB joined and cut rates as well, with the market thinking that they're going to do so again this year. And Bank of Canada also cut rates earlier in the year, and again for the second time this past week, with Governor Tiff Macklem thinking that they're going to do it again. So what is driving this second rate cut and anticipated series of rate cuts in Canada? So let's look at the data first. So according to the bank's latest monetary policy report, you can see that inflation really has been coming down towards their target range very well. It's been gliding towards where they want. So I can understand from their perspective, there's really no need for policy to be as restrictive as it has been. But more importantly, though, there are worrying signs that growth is slipping away. Now, when you look at their aggregate numbers, GDP growth is about 1.5%. So it's positive, it's not a recession, but that really hides some important per capita numbers. So one way you can grow your GDP, which is really just the amount of goods and services produced in an economy, is simply by adding more people, even if they're not doing super important things. Now, they're producing stuff, and so you produce more goods and services. Now, Canada increased its population by 3% in a year, and it's growing at 1.5%. So on a per capita basis, it's actually shrinking 1.5%. So even though they are not technically in a recession, the average citizen is definitely in a recession because their living standards are declining. Now, an interesting chart they show is that per capita GDP has actually been declining for 4 quarters. So it's, I think, putting a lot of pressure on households. Now, one thing you'll notice that's really interesting about Canada is that their interest rates, so again, the way that monetary policy works, of course, is through interest rates. For a lot of the people there, if you have a mortgage, you have to renew it, say, once every 5 years. So in a sense, you're somewhat on a floating rate standard. So as we've been in this rate hike cycle for a few years, more and more people who took really low rate mortgages a few years ago are now having to renew their mortgages at much higher rates. And that is pinching their wallets and reducing their ability to spend money on other things. So again, there seems to be heading towards a recession. And so that is causing Bank of Canada, I think, to be a bit more cautious on growth. So with inflation really close to their target and growth slowing, obviously they're going to be projecting a easier monetary policy. Now, looking at their labor market, again, you add a whole bunch of people in, even as your demand is slowing. That is foreshadowing a pretty weak labor market. So far, it's been fine. But Bank of Canada has this really interesting statistic showing that the percentage of unemployed people each month that are able to find a job is declining really rapidly, and it's approaching pretty low percentages if you look at this time series. So again, they seem to be very worried that the economy is heading towards the wrong direction. So what does that mean for their markets? Now, I think the biggest impact is probably going to be in their currency. Now, Governor Tiff Macklem and Chair Powell had a conference in Washington a few months ago, and someone asked Governor Macklem, you just do whatever the Fed does, right? Do you guys just copy the Fed? And Governor Macklem was very clear that no, they do their own monetary policy, and they have an escape valve, which is the currency. So when they have different economic conditions, so things slow in Canada but are fine in the US, they can cut rates, and that will be buffered by changes in their currency, which will continue to act as a source of easing, making their exports more competitive. And if you look at CAD USD, you'll notice that it's been surging. So the Canadian currency has been depreciating over the past few days. Now, it seems like there seems to be some kind of soft ceiling around 1.39. I don't know if we're going to punch through. We've definitely been hanging around that level for the past few quarters. But if the Canadian rate cutting cycle proceeds, whereas the US economy continues to do well, you can easily imagine that the Canadian dollar depreciate further against the USD. So we'll see how that goes. Okay, now the last thing I want to talk about is this really interesting paper by Stephen Moran, who used to work at the US Treasury, also a great follow on Twitter, and Norio Rubini, also known as Dr. Doom, famed for his forecasting of the subprime crisis in in 2008 during the Great Financial Crisis. So what they're writing about here is something that we've talked about over the past year, and many people have also noted that when the Treasury seems to be doing something with their issuance that is, in a sense, easing financial conditions. Now, in their paper, they provide a very clear description of how this works, and also they have an estimate as to how much they think this is impacting the markets. So at a high level, now when the Fed is doing QE, what they're doing, well, they're doing a couple things. One, of course, is that they're buying a whole lot of longer dated Treasury securities. And by decreasing the supply of Treasury securities in the market, basic supply and demand, if you decrease the supply of something, the price of something rises. And so in bond terms, that means it puts downward pressure on interest rates. And the Fed is totally open. That's what they expect to do, right? Doing QE, buying longer dated bonds, fewer longer dated bonds available for private sector investors. And so that puts downward pressure on interest rates. The second thing the Fed does is that the way that it purchases this is it basically prints a whole bunch of money. And so during times of QE, the money supply increases. And if you are a monetarist, you would think that has something to do with economic activity. To be clear, that perspective has been very wrong for decades and decades. But in any case, these are the two common channels people think of when they think of QE. Supply of duration and money supply. Now, this new paper suggests that when the US Treasury is changing the composition of its debt issuance, issuing more Treasury bills, fewer coupons, that has a very similar impact. So this is how they think of it. So if you say you have to issue $1 trillion in debt, well, the US Treasury, by simply issuing, let's say, a higher fraction of that in short-dated bills rather than coupons, you are also decreasing the amount of coupons, the amount of longer-dated bonds that the private investors have to digest. Mechanically, that's very similar to QE, right? Fewer supply of duration, downward pressure on interest rates. So that's pretty clear as well. The other point that they make is that Treasury bills, that's really basically kind of like money. So if you think about it, a Treasury bill is just an IOU from the United States government, kind of like a dollar bill that pays interest. Now, this analogy is especially apt because Treasury bills have very few interest rate risk, and also they are very liquid. So just like the Fed is printing a whole bunch of money to buy coupon treasuries, when you're issuing more bills, you are mechanically, in a sense, increasing the money supply. Again, it's not technically money in the sense that you can't use it to go and buy stuff at Denny's, but it's money-like. And so when the Treasury is doing this, they are basically doing a form of QE in effect. So looking at what the Treasury has done over the past few quarters, you'll note that the Treasury guides having about 15 to 20% of its issuance in bills. Over the past few quarters, it's gradually increased its share of bills so that it sits comfortably above 20%. Now, their paper looks not just at the overall outstanding bills as a share of overall outstanding, but also looks at the flow of issuance over the past few quarters and notes that the issuance over the past few quarters has been highly disproportionately in Treasury bills, suggesting that the Treasury has been having an impact on financial conditions. Now, the way that you estimate just how much of an impact, though, again, this is going to the realm of econometric models, which for reference only. But looking at different ways that you can estimate this, they come up with an estimate, let's say about 25 basis points on the 10-year. So they're thinking that what the Treasury did, increasing the share of bill issuance, has lowered the 10-year yield by about 25 basis points. And they equate that to about 100 basis points worth of cuts by the Fed. Now, again, this is all for reference only, but the overall idea has been that, yeah, the Treasury is doing this, and they are in fact, easing financial conditions. And this in part explains why, despite high interest rates, the economy continues to be strong and financial assets have gone through the roof. Again, we've talked about this, I think, a couple weeks ago when, Treasury official Josh Frost gave a speech explaining why he's responding to pushback that he's been getting, that he's goosing the markets. So the Treasury is thinking that, yeah, we're not doing that much. So, we're just doing something routine. And Treasury Secretary Yellen actually explicitly responded to this paper in commentary saying that it's not our intention to ease financial conditions. And I don't know if that's true or not, but I think I agree with this paper that it's definitely having an impact on markets, if at the very least psychologically, because there are certain market participants who believe it's easing financial conditions. Now, one other really important thing about this market is the potential future unwind. Oh, just an aside. So in addition, their estimate of the size of this issuance is about $800 billion in missing coupons. That is to say that if Treasury were faithful to its 15 to 20% share of bills, they would have been increasing coupon sizes. And if they did that, they would have been issuing 800 billion more coupons. And so again, that's a big number. What they're worried about, though, is that in the future, obviously, you shouldn't continue to be increasing bills as a share of total debt. One day, if we have a new Treasury Secretary or things change, what is going to happen when that new Treasury Secretary needs to unwind this and get a bill share back down to about 15 to 20%? Now, they're thinking that when that happens, you could have a sizable increase in longer-dated yields, maybe 30 basis points, and that could be I think that would tighten financial conditions going forward if we have maybe next year or maybe in a future administration when they finally want to wind down what this administration has done. So that seems to be, again, keep in mind that Dr. Doom is well known for having concerns. So for all I know, this could continue indefinitely. I think if you look across the world, many countries have a large share of short-dated debt as part of their overall debt stack. But we'll see. If they want to remain faithful to 15 and 20%, definitely there could be some financial turmoil in that process. Okay, so that's all I've prepared for today. Thanks for tuning in. This week is an FOMC week, and I will be back on Wednesday to give you my thoughts on the FOMC meeting. Again, if you're interested in hearing my thoughts, don't forget to check out my blog at fedguy.com, and don't forget to subscribe to this channel. All right, talk to you guys soon.